Hi, everyone. Welcome to another episode of the Rocket Your Dollar podcast. And as always, as everyone in our community knows, our podcast is designed to showcase individuals who work in and around the private investment space. And today, I'm very happy and lucky to be joined by Mitchell Morgan. I feel like since we both live in the same state of Texas, we could have actually probably organized a little bit better and done this in person. But the drive between us is a little bit of a bear on Interstate Highway. But without further ado, let me introduce the Rocket Dollar community to Mitchell Morgan. And Mitchell, maybe you could tell us a little bit about yourself, sort of where you're from, and sort of the quick background, and I'll drill in a little bit more
Yeah, of
to get even
course.
more out of your background.
Well, you got the name correct. I am Mitchell Morgan. My nickname is actually Mitt. It's just spelled MIT, one T.
Okay.
And most of my friends call me Mitt, so you can call me Mitt if you want to. I always like to kind of lead with I'm originally from Louisiana, but that's where I'm from originally. So a lot of, the culture and my background is in the history there, but grew up mostly in Texas. And I'm a finance guy. Graduated with two majors in both accounting and finance. Spent a little bit of time as a CPA, and within about 3 years, opened up a business with my wife. There's more to it from there, but
Okay. Well, let me ask you a question then. So, kind of growing up in Louisiana, like what led you to business in the first place? Was that something you always wanted to do? Was it someone that kind of led you down that path, or you just thought that that's the way that just fit my personality?
it yeah, I think probably about 50% of it definitely hit my personality. I'm one to be more independent than to be an employee, so I've always wanted to run my own show. Did so as a kid, but I think my mother, interestingly enough, was more of my inspiration. My father was from a sports perspective because he was always, the baseball coach. But
Okay.
my mother was an interesting story, coming from Louisiana and ultimately wound up being an executive for a publicly traded company. So she and I are actually a lot alike in that regard. And,
Okay.
a lot of the things that she would talk about just seemed to land with me. And that's probably why I entered into that particular profession. But everything else from there is probably a lot like our lives, that things kind of bring us in, our experiences bring about where we are currently. And that's definitely the case because the business that my wife and I started was in the healthcare industry. When we sunsetted that business because she had our first daughter, a friend of mine who was doing medical office buildings together with surgery centers brought me on board, and he and I effectively built a war room at his
Mhm.
house, and we structured all the deals from there. So doing commercial real estate together with him gave me the start in what I do. And
Okay.
when he sold his company in 2009, I essentially went out on my own. So from this point forward, I have called myself a financial architect
Okay.
because my clients mostly are commercial real estate sponsors, the developers, and
Mhm.
I architect the capital stack for them. So when they're wanting to build whatever they're wanting to build, if it's a medical office building or if it's an apartment complex, whatever the case is, there's a budget and I architect the capital stack, the debt, the equity, everything else in between. So along the way, I developed an expertise on the equity side of things
Okay.
because I syndicated all the offerings. Many of my clients will graduate to building a fund, and I become the fund manager in that regard as well. So
I
that's
got it.
that's a good bit of background on why I have
Yeah.
the experience that I do with self-directed IRAs as well.
Well, yeah, and let me stick with a little bit of the capital stack too, because
Yeah.
uh, I think a lot of people, when they think about real estate, whether it's commercial or residential for investment purposes, I mean, they think it's pretty simple. Like you cobble together money in the form of a down payment, and then you finance the rest from a bank. But I mean, just based on your description and the fact that there are people like you who help these developers get these deals for commercial real estate related to medical facilities and healthcare. I mean, it sounds
Hmm.
like it's a lot more complex than that. Maybe you could just kind of unpack that a little bit, because when you say like the debt, the equity, like help
Yeah.
explain it maybe to the level of a retail investor who just wants to better understand like what's the high level of the deal, because most people, what our community sees is just an offering
Yep.
document, the ability to buy one particular unit, whether that's equity or supplying capital in the form of loaning them money. But that's it, right? They don't have the 30,000 foot view of this particular project or how they're typically structured.
Yeah. I think it maybe the short version is what the retail investor sees in terms of an offering, and they don't know what's behind the curtain. I'm
Hmm.
probably the guy behind the curtain, structuring everything together, understanding I love the word architect because you have to have that vision of what needs to be the end result. And you have
Okay.
to be able to back that up into the components of, okay, well, what do I need to put together today to get this result at a later point in time? So yes, it's a lot like cobbling together various pieces, but it can get quite complex because it means you really have to have a very good understanding of the budget,
Yeah.
and what the outcomes are that you want, and you need to architect the all of the financing so that it can perform as you would expect it to. So
Now, do you do this in the form of was it a consulting capacity that you do this in, and then you just happen to have a network of developers, and they say, and let's say just one, we'll just pick on one project, but let's say that
yeah,
hey, I want to build a surgery center for example, right? Like something.
right.
I'm just using an example, but I need help. My guess is that I have context. I know I want to build a surgery center. My data research tells me this is a good spot to build it. I've secured land, but now I got to secure the deal. I don't really have an idea of how much this project will cost, how much I need, or how do I get capital, both debt and equity, to get this thing off going.
Yeah, no, 100%. And it can be quite difficult, and like we said, it can be complex, but going through that process of understanding, okay, you do want to understand the budget, and you want to have an understanding of what the return needs to be. And so that capital stack does need to be put together in such a
Mhm.
way that it can perform as you would expect it to. Most of my clients, the answer to your question, interestingly enough, I haven't had to market myself a whole lot. It's mostly been word of mouth. If you perform really well for one client, they have
Yeah.
others. They kind of birds of a feather flock together. So one tells another.
Okay.
And I think mostly my best clients have been the ones that they know that they can probably do it themselves, but they also
Mhm.
understand their time is better spent doing what they do best. And if I can take this particular component off of their plate and structure it in a way that it matches the performance that they expect, then I have value in their eyes. So that's where most of my clients come from.
I see. And I don't know if this is your particular part, but because you're in the business of doing this right now, financially architecting deals, you
Yeah.
have pretty good knowledge both as a personal user and then also as someone who's accumulated funds or at least helped a
Hmm.
client accumulate funds, partially from
Yes.
self-directed IRAs. So,
Yep.
maybe you could tell us a little bit about how you sort of first learned about this. I mean, usually people remember the first time they'd heard about, started working, and some of your own experiences maybe with a self-directed IRA.
Yes, I do. I remember it very specifically when I was working with a gentleman he was my employer, but in a lot of ways he was my mentor. And I like to say I probably got two MBA degrees while I was with him, because structuring deals with someone who has done it before and being able to pick up on the concepts and understand it, model
Mhm.
it, and be able to perform on it, it's a big deal. But when you get to the point where you've structured the deal and you have your offering documents together,
Right.
then the race begins to try to raise that capital. And what I began to understand very quickly is that there are two types of funds. You have your non-qualified funds, which are the before tax dollars that someone can invest. They can literally just take money from their existing bank account and they
Right.
can send it to the sponsor and invest in that particular project. But the other world that got opened up to me that I was unaware of at the time is that there are qualified dollars as well. And these are pre-tax dollars, and they're sitting in uh, tax advantaged accounts. So whether it's a tax deferred account like a traditional IRA, or if it's a tax free account like a Roth IRA, it's all in the same bucket.
Right.
And this was 20 years ago when it was somewhat of a novel idea that, hey, there's all these existing funds that are out there. How can we get to those funds? And so everything that is probably better understood today in the whole world of alternatives in a way, it kind of felt like we were pioneers at the time
Yeah.
because we just wanted to have access to a greater source of funds than just the before tax dollars. So that's how it got introduced to me. So to
Yeah.
understand what these structures, were looking like and also how to become good at helping a potential investor transfer accounts, say from their 401k that they had with their employer, and get those funds over into what we knew back then as a self-directed IRA. We didn't
Mhm.
have the checkbook IRAs back then, so
Sure.
you had the custodian involved just like you do today. But yeah, this was 20 years ago when we were really just trying to move into new territory of accessible funds. And
Mm.
that's how I got started.
Yeah, and what I've sort of learned over the years, having rocket dollars of business is that it kind of also, in a way, you hear the term, you've probably heard this before, but people talk about democratizing access to private investments, and then that's
Yeah.
typically understood to mean that a particular deal that
Hmm.
might have prior to putting itself on a platform was only accessible by institutional or high net worth or qualified purchaser type investors,
Exactly.
a very large dollar. And
Yep.
now it's available in a smaller dollar amount to retail investors. But I think that that was just only one piece of it, that when it became a little more known that you can access tax advantaged accounts like 401ks, IRAs, in the
Yep.
form of self-directed IRA to do those investments. Now those non-institutional investors found that they actually already had a source of capital that had really good tax treatment, was already
Yes.
earmarked for long term, and can only be used for investment purposes, right? That's kind of the definition of money in an IRA. You can't use it to go buy something that you want right now, like a consumer discretionary item. Uh,
Right.
you can't access the money until you're 59 and a half under most circumstances. So it doesn't pay taxes as long as you follow the rules and leave it invested for the long haul. And those
Exactly.
characteristics actually lent itself very well to private investments. And so the being
That's a
accessible
very
was
good,
one side, but you needed the
yeah.
other half to like really make them meet. You
That's
know.
actually a really good point because in a lot of these alternatives, especially in a real estate deal where, the hold period can be anywhere from 3 to 7 to maybe in as much as 10 years, it
Yeah.
really kind of matched the what we would call the horizon on behalf of the investor. That if they were accessing, maybe they're in their 40s and they have
Yeah.
access to, a tax advantaged account, and they know that they can't take distributions until they're 59 and a half. Well, you've got that whole runway to put it into a project where I think the expectations as far as time and return match that alternative investment class.
Right.
So it
Well,
really
especially
became a good
now,
match in that regard.
yeah. And then, in the public markets now, people's expectation with maybe the rise of a digital asset
Yeah.
economy be that their expectation is even faster. Like, they want to return in a
Right.
week, maybe even
Right.
daily,
Yeah.
so forth. So these are kind of there still as long-term investments. But um, and then you talked about accessing the funds. I mean, I was just talking to someone that now that amount in tax advantage accounts is in excess of 46 trillion dollars in the U.S. So this is a lot
Yeah.
of money that probably clients of yours are going to want to have access to fund their deals. But
Yeah.
that being said, one of the things you were telling me too was that I think we get a sense of the day to day now in Mitt's life, but what are you working on now? You were talking about that. Okay, you kind of cut your teeth. You got into
Yeah.
went from healthcare to commercial real estate. Sounds like a lot of the
Hmm.
deals you're architecting were also related to healthcare and
Yeah.
so forth. But the last few years you've been working on some projects and kind of seeing like a different ahead of the curve on the investment horizon of another asset class that you've kind of been really
Yeah.
deep into. Maybe this is something you can introduce as the new one. This is what I wanted to tease the
Yeah.
community
Of course.
we were
Of
talking about.
course. It's been an interesting seat to have in terms of perspective. This is something that I've just been familiar with for over 20 years. And it really has been interesting to see, especially a lot. I mean, you see it more and more on social media.
Mhm.
The more marketing that takes place about, hey, you can invest in the things that only the wealthy used to invest into. And it's now, like you said, it's more democratized. So there's this whole world of different asset classes that at heart, everyone is an investor, and whether they have a money manager or if they decide to invest in things themselves, they want to
Right.
be able to pick and choose the right asset classes that are going to fit with whatever their goals are.
Right.
And, for me, I began to look at it in that perspective as well. I knew that based upon my experience with real estate developers, I became very, very, very skilled at understanding real estate in and of itself, and if it was a good deal, if it was not a bad deal. But along the way, I would say there's another 50% of my clients that came from, mergers and acquisitions. Probably one of my most interesting clients to date was a baseball sports agent that wanted to build a large facility for indoor volleyball and indoor basketball. And that was a really big project as well. But probably the one in my time span that really captured my attention the most was this asset class called life settlements, which basically it's essentially a secondary market for life insurance policies. So an investor will come in and purchase that policy and they'll carry the premiums. And then when the maturity takes place, then the benefit now belongs to the investor. And it's really interesting too because the transaction in and of itself, in my opinion, is it's quite altruistic. And what I mean by that is it's a win-win scenario because these are mostly seniors that want to sell their life insurance policy because they either can't afford the premiums or just don't want the policy anymore. And it matches at a point in time in their life where they feel like they need cash for whatever the reasons are. So they take that policy to the secondary market. If it's done correctly, they'll get a broker involved. So you think of it a lot like real estate. A broker is involved so that they can get the best price on behalf of that individual. And by the way, this secondary market will almost 100% of the time offer that senior more than the cash value of the policy and more if they just certainly if they just surrender it. So it
Yeah.
becomes a win-win scenario because the investor comes in, they pay a discounted price for the life insurance policy, and the senior now has benefit of cash that they can use for whatever their needs are. Probably one of the other tweaks in there is that that benefit can be divided. In other words, the senior can still keep a portion of that benefit and they can sell a fraction of the benefit as well. So all those
Okay.
things combined just create that win-win scenario. So for
Hmm.
me, what really began to attract me to this particular asset class is that it was providing a good on behalf of the seniors. But the biggest thing about it is that it's non-correlated. And what that means is, you know, every asset class has risks involved and it carries dependencies that make that particular asset class successful. Well, let's take real estate for an example. Right now, and this, by the way, I want to say it doesn't make real estate a bad asset class, but in
No.
the environment that we're in today, everything that the real estate is dependent on, those factors just aren't aligning. This is an asset class that is not correlated to the markets because it has nothing to do with an interest rate, has nothing to do with who's in office, has nothing to do with what's going on politically or geopolitically. It's a very non-correlated asset class that if it's handled correctly and if it's structured correctly, then it has the capability of performing in a way that can balance out the rest of someone's portfolio.
I was interested because I'd never really heard about this asset class, and maybe one of it, and you might know different. But just for purposes of it's an investable asset class, but
Yes,
it's one of the actual codified things that are not allowed to be owned inside of an IRA itself. So we're talking about this as an asset class is upcoming, but not one that actually would be purchased for inside of a self-directed IRA itself, because that's actually because life insurance is not allowed to be owned.
that's a great point. So you cannot invest personally in a life insurance policy for your own benefit, but it
Okay.
is allowed to own it as a third party if the insured is someone other than yourself. So, yeah, that's
Or someone who would be prohibited. So like you wouldn't be able to buy your spouses or your child.
exactly,
Um,
exactly.
okay. And okay, and then
So
other
in other words,
question
like the
about
test of insurable interest, there cannot be an
it.
insurable interest in this case.
Well, and that's what kind of leads me to my next question is that,
Hmm.
why are people allowed to buy these policies if they don't have an insurable interest? Because it kind of reminds me, and this is a weird world, but
Hmm.
I had a pitch deck come across, my desk, and we didn't talk about this before, so I didn't give you any prep on this, but I had a
Yeah,
pitch
that's
deck
okay.
come across my desk that there's a secondary share offering going around for that new platform slash website called Kalshi, which allows you to bet on every scenario. And the
Yeah.
valuation on a pre-market is actually at $20 billion for this
Yep.
company. So, of
Yeah.
course, these are people betting on things that they have no real, personal interest in. It might be like, it's going to rain tomorrow or
Right.
and so forth. But are you insurance companies are okay with someone like me buying an insurance policy or a basket of insurance policies for people that I have no personal reason why I'd want that person to live or pass away and so forth. I mean, they don't owe me money. They're not
Right.
related to me. I don't depend on them as an example.
Right.
So having no insurable interest allows me in this structure to purchase an IRA. But now I'm
Hmm.
asking the question of like, why would an insurance company allow me to purchase a policy on someone that I have no skin in the game for whether they die or live?
Another good question because this was a case that came up, I believe, in the uh, late 1900s or maybe
Okay.
in the 1920s, that there was a legal case specifically that was decided in favor of being able to allow a third party to own a life insurance policy. So
Hmm.
that what you just presented was a legal case that needed to be decided many years ago. And the net result today is again, it's very much like real estate because it what was decided in that court case is that it is a piece of property that an
Okay.
individual can either sell or they can keep. But if they sell it, it will be a lot like real estate because there's title involved,
Yeah.
and there's a lot that needs to take place, just like in a
Um,
real estate transaction. So,
and maybe this is like a related question then. So if an investor were looking to get into this asset class
mhm,
and they go through, let's say, what you talked about, this marketplace, which has brokers, the same way that you might have realtors and real estate agents in a real estate transaction to help get the best price possible to
right.
match the buyer to the seller. But is it a one-to-one, or is someone typically purchasing into like a fund or like a bundle, or how does that work?
It's a lot like many other alternative asset classes in that if you really started to peel back the layers, you would probably get to a point where you would understand, wow, I can probably do this directly myself. And that's the case in this situation as well.
Okay,
There are certain things I don't want to get too far off track, but
sure.
the process of being able to purchase a policy, if you're an individual that wanted to invest directly into a life insurance policy, it's going to
Held by just
require
one
being in a
individual.
pardon?
If you wanted to purchase one held by one individual.
Just by one individual or two, or if you wanted to,
Okay.
purchase two or three or four.
Oh, okay, okay.
Um, the fact of the matter is that there does have to be, and this is by regulation. By the way, the secondary market, it's a lot more mature than anyone, in my opinion, is even aware of.
Hmm.
But it's very robust and quite a large marketplace. All 50 states are pretty much regulated the same way. And in all 50 states, there has to be what's called a provider that initiates that actually consummates that initial transaction. The provider can be a lot like a title company
Okay.
because the transaction initially has to go from the seller of the policy to that provider. And then it's essentially like a double close because then that policy can then be sold by the provider to an investor. Can that investor be an individual? Yes, of course. But most people just aren't aware of the marketplace, nor do they know where to go. And that's typically where a sponsor will step in that has been around that block before and has the experience and the expertise and the know-how and the knowledge of how to structure it, and puts it together in a package that can then be offered to a retail investor, the normal, just average Joe that says,
Hmm.
yeah, I want to do this too, but I don't know the first thing there is about it. I like the asset class. I understand it. I love the non-correlated nature. I can see the
Sure.
benefit of having something like that in my portfolio, but I don't know where to go. And so that's typically where a sponsor steps in and packages it and offers to manage it at the skill level that the individual probably just doesn't have the time or expertise to bring to the table.
Or maybe it also provides diversification, right? So, I mean,
That's a great point
at that point,
too.
the sponsor isn't buying like one, two,
It,
three, or four. They're buying like, three, four, 500 or 1,000.
Exactly, exactly. Which is the case in my structure because a lot of the expertise that we bring to the table is putting together a portfolio of life settlement policies rather than just having one or two, or we have more like 15 to 20 to 30 to maybe even as much as 50 policies in a portfolio. So it
Okay.
helps to spread the risk and it also helps to kind of even out what the returns look like.
Okay. That is, and then this is just kind of my last question. This is about really me digging in. So this is
Yeah,
kind
of
of what I
course.
do
Yeah.
on these asset classes. This is how I learn. And then we share it with the community. But um, is this generally something that the large insurance providers actually are happy with? I mean, so before you answer that question,
Yeah.
my initial thought is that the answer would be yes, because they get to continue having enforced policies
Hmm.
with premiums being paid,
Yep.
and as opposed to otherwise, these people are just going to surrender those policies and take the
Right.
cash value,
Right.
or stop paying the premiums altogether and let the premiums be, paid for by the cash value, right? So either way, there's
Yep.
no real new money coming in. It's just kind of a moving,
Right.
marbles from one side of the table to the other versus no
Yep.
new marbles getting put on the table.
Yeah.
So that'd be my
It-
guess initially as a dumb non-expert in the space.
no, it's a fair question. And there's initially when this market came into existence, which by the way that really kind of initiated and gained a lot of popularity was, during the time when we were dealing with viaticals, especially individuals that had, a lifespan that was deemed by a physician to be very short.
Yeah.
But it matured into the marketplace that it is right now. And yeah, there's some pushback originally from the life insurance companies because it's easy to understand they would far prefer that individual to just have paid on that policy for 20 years and then just say, "Hey, I can't do it anymore." And now
Oh,
the
okay.
life insurance company is not responsible for that benefit payout at anymore. But going back to that legal case, um, and forgive me, I can't remember exactly what it was called, what the moniker was or what the exact date was, but it took the legal aspect of that court decision to really enforce upon the life insurance companies that it's okay for a different owner to have title to that policy and to that death benefit
Yeah.
and that they would continue the payout. But there's another part of them too that also, probably, not all policies are paid. The premiums aren't paid by the cash value that's in the policy. Those premiums have to continue. So, you know, yeah, there's a little bit of pushback from the life insurance companies originally, but they also really enjoy those premiums to continue.
I guess that makes sense, right? I mean,
Yeah.
at this point, probably statistically, longer longevity or higher longevity is on their side, versus
Yeah,
less, right?
exactly.
So,
Exactly.
okay. That makes sense. Well, thank you very much, Mitchell, for kind of sharing that. Maybe as we close here, maybe you could share with us, like, how do people find you, the financial architect, whether it's to learn more about, the deal that you're sponsoring now, whether it's maybe some people that still are looking for help. I mean, we got a lot of developer people in our community as well, so they might still be looking for someone to help structure
Yeah.
deals for them as well. But where are the best channels to sort of find you?
Well, if they're listening to this particular podcast and they're familiar with Rocket Dollar, then probably the easiest way might be on your website. My original thought wasn't necessarily, hey, I could benefit from being a partner. It was more
Yeah.
like there's a part of me that just got excited that all of my experience could probably offer you. You know how it's like it takes a village to raise a child, and you probably feel that way in your business because you're the only one that's communicating the
Yeah.
value of these accounts. And I'm just a third party that has utilized them professionally, and I thought it would probably add a lot of benefit to everything that you're saying. That being said,
Sure.
probably the easiest way is just look me up as one of the partners on your website. But I can also be found on LinkedIn. I'm Mitchell Morgan. You'll see me out of Grapevine, Texas. Or my website is mlane-inc.com. That's M as in Mitchell, L Larry, A Apple, N Nancy, E Edward, dash inc.com. That's so you can find me.
mlane-inc.com. Okay.
Yes, sir.
Well, maybe as we leave here, we were talking about this before, but you look like a
Yeah.
man of many interests. So I see the baseball on one side, I see the guitar
Yeah.
on the other, and
Yep.
for me, I think to myself that I probably need to get more hobbies, at least interesting ones that I'd be willing to showcase out in public.
Ah,
But
you'll find
are,
it.
are you musically inclined? I know you mentioned baseball as a kid, and are you the coach
Always
now for your kids' baseball, or?
always have been. And I had daughters, and that's not unfortunate, but they're
Yeah.
not sports oriented. But I always have been. That's 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 an old just a keepsake that I had from a little league team. And as far as the music is concerned, I'm a blend of I'm structure first, but I have a great amount of creativity as well. And so that's just kind of my outlet. And
Got it.
I don't just keep it for the camera. I literally keep it there because sometimes I just need a break from what I'm doing, and
Okay.
that's a great way to kind of get into a different mindset than all the structure.
Got it. Well, it's always fun to learn a little bit about what makes successful, hard working, driven people
Yeah,
functions. It's always
which by
nice
the
to
way, I
share.
know it's probably my preference all the time is blues. And you being in Austin, Texas, got to catch a little bit of Stevie Ray Vaughan when he was up and coming. So
Yeah.
that was a great deal.
That's pretty nice. That's awesome. Great story. Well, thank you very much,
Yeah.
Mitchell, for your time today. I appreciate you stopping by, telling us about sort of what makes Mitchell or Mitt, and then sort of how you came into this like new asset class. I mean, as I mentioned, I hadn't heard about it before, so I appreciate you letting me sort of drill a little bit in to
Yeah, of
learn about it
course.
from
I
different
appreciate you
perspectives, people
asking.
people around the table. I don't know if normally people do that, but I was always taught by my by good teachers that I had growing up and parents that you ask questions, like ask four questions, and then you get the real answer and you start to understand. So
Yeah.
um, not the same ones, but just clarifying and follow-up questions, and that's what helps sort of
Yeah,
lead
of
to
course.
understanding. And then that's what the world of self-directed IRAs opened up capital, right? But obviously people need to have an idea where to deploy that capital in the non-public market. So being able to learn about a new asset class and someone who's been successful and what I
Hmm.
might argue it in one of the traditional routes, commercial real estate of private market investing, and now looking
Yep.
expanding into an asset class I wasn't very familiar with. So I'm sure we'll hear a lot more about this over the next few years. But Mitchell,
Yeah.
thank you very much for joining us today, sir, from Dallas,
Well,
Grapevine, Texas.
thank you for what you do at Rocket Dollar.
Thank you.
It's a wonderful service, so I appreciate it.
Thanks.